Hello everyone, I am Sidhant. Today the third chapter of the accounting and finance for the bankers. Before that, one thing is very clear, that utilization of the Saturday and Sunday is very important as far as the bankers are concerned, because these 2 days is the plank of getting something out of any examinations or any certification course. So utilization of Saturday and Sunday is important. Utilize it, revise as much as you can. Understanding the basics is one thing, and with the basics, building an empire from that basics is another thing. So the building of an empire could only be done if you devote a time in solving questions or simplifying the complexities of the questions by having the understanding through various sources, and through this you will easily get a very good score. So let's begin the third chapter, which is a capital budgeting. In the capital budgeting, first we will understand what is capital and what is budgeting. The capital is nothing but an investment to create some assets or decrease some liability. It's a simple definition, but you should understand here in our course, the capital means creating an asset. Creating an asset means to invest on something, to buy some plant and machinery, to accept a project, to invest in the project is the capital budgeting. And the budgeting is nothing but the revenue and expenditure of the particular company. So if some company are investing in something, is done through the capital budgeting. In the capital budgeting, they see the future of the investment they do, whether they will be in profit or not in future. So this capital budgeting is applied by the company. Previously we have seen the YTM or the annuity or interest concept. The capital budgeting is also the application of the interest and annuity. And in YTM we have seen that the bank or the customer applies the yield to maturity to calculate the value of the bond. But in the capital budgeting, it is usually applied or used by the companies. The recent example of Adani Group investing in the Airport Authority of India. Why they are investing? Because their board of directors or some people which calculates the capital budgeting, that whether they will be in profit or not in this business, or in this particular business or not. As we know that Adani till now hasn't entered to the airport businesses, though he has lots of businesses in it, but they are entering because they have something in mind. They calculated through this capital budgeting whether they will be in profit or not. Now we will see the first introduction. I already told you what capital budgeting is all about, and one thing that we are using, see, the JAIIB syllabus is very fantastic, because the first chapter you read, it will have an applications in the next chapter consequently. So what you need to is just understand, and in the next chapters you will have to apply. In the first chapter itself, we have understood that some amount are given as loan, and the first year, second year, third year, or some amount are invested in bond. In the first year you are getting something, you are getting something, you are getting something. So we are finding what? We are finding the present value in order to find whether we will be in profit or not by comparing with the invested amount initially. Similarly, in this we will do the same thing. We will see that in the capital budgeting, first in the first year how much they are invested. Let's say they are invested 50,000 of rupees. Okay, and in the after the investment, they will after some time they started getting profit from the businesses. Let's say in the first month they are getting 10,000, 20,000, 30,000. So you will have to calculate whether this whether the company will accept this project or not. Why they will accept the project? Only when they are in profit. So we will again calculate this present value and we will see, compare with the investment we made. So if we compare, if it's a positive, which we call it a net present value in this chapter, if it's a positive, then we will invest in it. They have the two projects in hand and they have some money to invest, let's say 50,000. So it's a project A and it's a project B. So in the first project, they calculated that in the first project we are getting this much, and in the second project they are getting 20,000 in first month, 10,000 in first month and 30,000 in the third month. So again they have only 50,000 rupees and they have to invest in either of the project. So how they will choose? They will choose by that application of the capital budgeting. They will calculate the present value of all this. They will calculate the present value of all this, and the one in which they are getting more net present value, they will choose that one. This is the concept, overall concept of this capital budgeting. So the next present value, next topic is present value and the discounting. Since whenever we, for some year, we are finding the present value, we are doing nothing but a discounting. And from the first year, if we are finding a future value, we are doing nothing but a premium. This you should keep in mind. And the present value is nothing but the discounting of the particular year value to the present value when the investment were made. And how you can mathematically represent discounting value, as we have read that when we need to find the present value, let's for the first year, let the amount is 100. How we can find? We can find that 100 1 plus, let's the rate of return be 10%, 10 by 100 1. So this much present value we will get for the first year. So this is this value, which is nothing 1 by 1 plus 10 by 100 to the power 1 is discounting factor. Okay. The next topic is discounted cash flow techniques for the investment appraisal. This is nothing but for various year, what we are doing, we are finding the present value, which is nothing but we are doing this discounting of the particular year with the present value. So this is nothing but a discounted cash flow techniques for investment appraisal. Investment appraisal means you are seeing that which investment you are going to profit more. So here in the example, we are getting more profit. Let's say in project B, then they will invest in the project B. This is nothing but an investment appraisal. And discounted cash flow, these are nothing but once the investment are done once, then they are getting profit every year. So these are nothing but a cash flow. And when this cash flows present value are found, then it is called a discounted cash flow, because we are finding the present value. Now we will understand what is net present value and IRR. These two topic is very important as far as the examinations are concerned, because numericals can be framed or they are framing in from this section to calculate the net present value or calculate the IRR. There is a very less chance that they will ask the IRR, because IRR is a trial and error method. If you don't have any scientific calculator, and if you have the scientific calculator, then only the IRR can be found easily. But if you don't have the IRR scientific calculator, then IRR can be found through hit and error method. Question is, your friend wants to borrow rupees 50,000 for 3 years from you. He made an arrangement proposing to give you $18,000 in the first year, 20,000 in the second year, 22,000 in the third year. If you put money at the rate of 8.5%, should you consider lending? Or in other words, what you want to say, that you are giving a loan to your friend and the friend pays you the amount 18,000 in the first year, 20,000 in the second year, 22,000 in the third year, and you are charging 8.5% interest to your friend. So whether you will give friend this much amount or not, you will see that you are in profit or not, then only you will give. So what we will do, we will calculate the net present value. We will calculate the net present value. How? Since your investment is 50,000, and in the first year, second year, third year, you are getting 18,000 of rupees, you are getting 20,000 of rupees, you are getting 22,000 of the rupees, and you are getting your 8.5% of interest. So your when you will find the present value in the bond, we used to apply, since the annuity, all the values are same, so we applied the annuity formula, and in the last year, whatever the annuity amount and the face value amount we are getting at the last year, we are just doing the present value of that amount. Here, since the amounts are differ, so we cannot apply the annuity here. We will simply find the present value through the compound interest formula. So how we can find? 18,000 1 plus what is the interest given, 8.5%, okay, and 1, again 20,000 1 plus 8.5, 100 by 2, because it's for 2 years. Discounting is for 2 years, and for third year we are doing 1 plus 8.5 by 100, 3 years. So if you collectively find this amount, you will get 50,802.94 rupees. So you have invested this much, and the present value you are getting this much amount. So how much net present value will be, which is nothing but this much minus this much. So 50,802.94. This is the value. And if the present value are not taken into concern, we just, for the layman terms, those who are not very financially sound, they will think that 50,000 we have invested, and we are getting 22 plus 20 plus 18, we are getting 60. So we should invest in it. But there might be possibility that the present value is more than this or not. Here in this case they are getting more than that, so here they will invest. But most of the time, if they are not getting the present value, then the net present value is not profitable one. So that's I wanted to convey. So this much we have found. This is net present value. There is another method where we can find the comparison between the project where they want to invest, where we should invest, is through the internal rate of return, which is called a IRR. Now, how IRR found? IRR can be found that IRR is the minimum amount, minimum present value you are getting, so that you neither gain nor profit. What does it mean? Here, let's say in this example, here you have taken 18,000, 20,000, 22,000. So at what interest this all amount, if they are presented or discounted to the present value, you will get 50,000 of rupees. How you can find these? But what is the R? So that we are getting exactly 50,000 of rupees, so that what you have invested, 50,000 you are invested at present, at the first year or the initial investment, and overall you are getting 50,000, so there will be no gain or loss. So what will be the R here? So that you are getting no gain, no loss, that is 0. So R will be, R is equal to 9.36%. So here one very good conclusions which could be asked in the examination, not directly the IRR value, they will not ask the directly calculate the IRR value, but they will give the 2 IRR value, and they will ask you that whether you will select this project or not. So one thing you have the conclusions like that when the percentage were 8.5%, you are getting net present value positive. It means you are doing profit in it. So IRR is 9.36, and in this 9.36, what is the net present value you are getting? It's a 0. The NPV is 0. NPV you are getting 0. So at R 9.36, net present value you are getting 0, and when the R is less, that is less than the IRR, when R is less than the IRR, that is 8.5 is less than 9.36, you are getting positive net present value. So here the very beautiful conclusions you are getting, that once if the rate of interest is less than the IRR value, then you should select the project. I will write here, say IRR is greater than the given rate of interest, then project will be selected. You will invest in this project. But if IRR is less than given rate of interest, then project will not be selected. Similarly, if the net present value is positive, then selected, and if the net present value is negative, then not selected. And what if the net present value is 0? Then it depends on the person. They are neither profiting, they are neither losing. So it depends on the person itself. They will select it or not. One more important, what is the problem with the IRR? As you just seen that you are getting only interest rate. You are not saying how much amount they are going to invest or how much profit they are going to get. In the net present value, you are getting some value, but in IRR you are getting in percentage terms. So let's say if a project is 100 of rupees, and after some year, let the net present value of all the years investment amount is 100 rupees, and to all the years they are getting 220 of rupees. So what the total interest they are getting? They are getting 120% of the interest. They have invested 100 rupees, and let's say they are getting 8, then 10, then 20 for 10 years. And if we find the present value of all these values, then we are getting 220 as total. So the net present value is 120. So the 120% amount they are getting. But let's say they are investing 1 lakh of rupees, and here total overall they are getting 1,65,000 of rupees. The present value of all the cash flows they are getting is 165. So the net present value is 65,000, and if we find in percentage terms, it's a 65%. So if we compare the percentage, here we are seeing that it's a 120%, it's a 65%. So if we apply the IRR, if we see the in percentage terms, then we will blindly believe in that 120% is more, we will select this one. But if we go inside, we will see that only we are getting 220 of rupees here, but here we are getting 1,65,000 of rupees is more fruitful as the scale of businesses are concerned. So if the person has money, then they will invest in this, and if we see the IRR, they will not get to know that how much is the scale of the businesses. So this is the drawback of the IRR and net present value. What it gives the actual amount. We are comparing the actual amount, so there we can know the scale of the businesses. So net present value is more fruitful or more important as compared to the IRR. here whatever we have calculated, the net present value or the internal rate of return, we are not taking any conditions or any uncertainty, not taking into concern. We are just considering the cash flows, the probable cash flows we will get in the future, just we are considering. So in this calculations of the net present value and the IRR, if we consider the uncertainty conditions which could be in the future with these cash flows, so there are influences in the cash flows. The cash flows might increase or decrease. So these uncertainties, if taken into concerns, then the net present value and the IRR can also be calculated. But there is a different method. Here they are getting 18,000, 20,000 and 22,000. We are just taking the previous example with the uncertainties we are taking, and we have invested 50,000 of rupees. So let's say in this 18,000, what is the probability we are getting 18,000? They have the internal calculation of the risks or the risk premium, etc. So they are thinking that at least we are getting 40% of this. So by taking the risk into concern, they have a different values as compared to the 18,000 here. So with this they will calculate the net present value, and with this applying the different permutations and the combinations in it, they find the values. Though it's not important as examination point of view, they will simply ask the net present or the IRR, but we will just understand that there is something as it's mentioned in the book, so I am telling you. So when the conditions are taken into concern or the uncertainties are taken into concern, and if we calculate the net present value, that is the finding of the net present value under the condition of uncertainties. So this is you should know. And the net present value is and when we find the net present value like this by considering the uncertainties, then it is called expected net present values. So the next topic we will move on is risk adjusted discount rate approach for the net present value determination. Here we will consider the different risk, and we will take into concern the risk associated with it. As we know that in the banking system, how risks are classified, they are classified as very low, medium, high, and with this they have the particular designations or particular risk values they allotting with the classification of the risk. As in the provisioning there are very risk, and with the risk factor they provisions the amount like 50%, 75%. Similarly here the risks are classified first, and then with that the percentage are designated to the particular risk, and with that we will find the net present value. That is nothing but a risk adjusted discount rate approach for the net present value determination. That's it. I already told you the basics of the net present value and the IRR. What I have told you is important. They will not get into so much in depth, but you should also know that, because theoretical questions can be framed from that sections as well. The decision tree analysis for the net present value estimation. Here they are analyzing with all the year wise the amount of interest. They will make a tree like structure, and they will compare with the yearly returns they are getting. So this is nothing but a decision tree analysis for the net present value estimation. The next is non-discounted cash flow techniques is the payback method. As the name suggests, the non-discounted cash flows. For example, understand, let's say 50,000 of rupees you are investing, and you are getting 7,500, 20,000, 15,000, 7,500, 3,000, and so on. Similarly, for the project B, you are getting 10,000, 10,000, 10,000, 10,000, 10,000, and so on. Here what we will do, we will not discount the values, we will simply calculate the value. If you calculate the value, we are getting 7,500 plus 20, 27,500, then 42,500, 7,500, then 50,000. Here we are getting 50,000. What we had invested, we got the money in 50,500 after 4 years in the project A, and the project B we are getting 3, 4, 5. After 5 years we are getting the 50,000 what we have invested. So since we are not discounting here, we are not finding the present value, we are simply taking the values, then we will compare these two projects and which project we will choose. It will be chosen according to the less year it will take to regain the amount we have invested is the payback method. So here we are getting our payback in 4 years. In 4 years we are getting all the payment that we have invested, and in the second project we are getting 5 years to get all the payback of the investment that we did in the initially we did in the project B. So here 4 year, here 5 years. So which project is better? This 4 year project is better, because at the less amount of time we are getting our investment back. So the first method is better according to the payback method. Here we are not calculating the discounted values, we are just calculating the amount as it is. I will again want to discuss the decisions tree analysis for the net present value. So we are discussing the decision tree analysis for the net present value estimation. What I was saying, that for every business there are two phases, like the boom period and the recession period. In the boom period the business are at its peak, they are doing a very good businesses, but in recessions they are not getting the amount of profit they want, and they are in loss. So these two phases. So whenever some company want to invest in the project, they will take this into concern, that whether the business in the next coming years will be in boom or in recession. So how they can do, they let's say they invested 50,000 rupees when the market is at boom. So there are very less chance, let's say 0.1, that is 0.1 probability or 0.9 probability, 0.1 probability that the market will be, but there is a more chances that 90% chance that the business will remain in the boom. They are taking both the things into concern, but with a different probability. So here they will think that what is the amount if the recession happens, which is just a 0.1% chance or 10% chance, how much they will earn in the first year. Similarly, when the business remains at boom, how much they will earn in the first year. Similarly, again they will think two possibilities, and here also they will think two possibilities. So here what is being done, that a tree is made with the two possibilities for each year, so that you can analyze all the possibilities, and we will trace out that whatever be the conditions, that even if it went to the recession, then also the company does well. So they just take all the probabilities, permutations and combinations, just to know that whether the business will flourish even if it's in recession, and they will get the amount extracted from it, the least amount, that so that they will not be in loss. So these are done to ascertain that they will not be in loss at a very high extent. Even if they are in loss, they will manage in the future years. So they do it. So that's it. You can read the book, you will understand. If you get any problem, you can ask me. Thank you.